Good morning from London. I'm Kriti Gupta alongside Tom Mackenzie. We're about an hour away from the opening trade. Here's what you need to know. Now, the big rotation about to be tested as earnings from the biggest companies on both sides of the Atlantic are coupled with rate decisions out of the Federal Reserve, BOE and BOJ. Meanwhile, here in the UK, Chancellor Rachel Reeves due to announce the date for the budget and reforms as she aims to, quote, fix the foundations of the British economy and expose the spending squeeze that she inherited. Plus, Israel attacked Hezbollah targets on Sunday, threatening further retaliation for a rocket strike that killed 12 children. Fears rising around further escalation as a truce in Gaza remains on the line.
OK, the countdown to the opening trade, of course, coming up. But in terms of the market setup, European futures pointing brighter. But what a week for these markets in terms of the central bank action, the earnings action and the data as well. We keep an eye, of course, on the geopolitics, and we reference Brent on the back of that, currently 81.65. In terms of European futures, though, pointed to gains of 0.4% after 2 weeks of losses. FTSE 100 futures looking to add around 32 points. The US two-year yield, where a lot of work has been done, of course, money moving into the front end of US Treasury debt, 4.36 as we lead up to that Fed decision, and the language from Jay Powell consequential as markets continue to price in the first cut in September. Yield just moving 1 basis point. The countdown to the opening trade starts right now.
Good morning from London. Look, there's a lot to digest, a lot of news from over the weekend, but I think it's maybe what's ahead that may be moving more of the markets. We have geopolitical news coming out of the Middle East, plenty of campaign news coming out of the States, plus plenty of news right here in Europe when it comes to corporate space and, of course, how Rachel Reeves is going to be handling that UK budget. Those comments expected later today, but I want to start the show, I should say, by kicking off, Tom, with what we're expecting in the next 5 days or so, because we get rate decisions from the Federal Reserve, the BOE, the BOJ. We've got plenty of earnings stories. There's a lot to digest. I'm not really sure what moves the market more.
This is a mammoth week for these markets, and you're absolutely right. That is a key question, isn't it? Is it the earnings story with the focus on technology of last week, the relative disappointment and concern about the spend coming through from Alphabet? Is it that story that continues to be the key driver of these markets, or is it that focus on central banks? And each of these central banks, when you lift the hood, has their own really fascinating idiosyncratic story and a number of questions around each of those central banks, whether it's the BOJ, the BOE, of course, the Fed.
You know, I got to say, I know all the hype is around the Federal Reserve, as it should be, but I feel like the BOJ might be the real game changer here. And it comes off on a day where we're going to get tech earnings as well. So this idea of a rotation, this idea of moving a lot is fairly interesting. And on top of that, we get plenty of fiscal decisions as well, because we of course, have that budget announcement from Rachel Reeves. We'll talk about that in a moment. But I think it's really fascinating because I think so often we have these big mammoth weeks. And then on Friday, we end up from market's place right where we were on Monday.
Yeah, so gains coming through in terms of the US story by the end of Friday. But, of course, on the week, there were still those losses. The Nasdaq down now, close to correction territory. Let's just meditate on that for a moment. Close to correction territory for the Nasdaq, down around 8% since those record highs. So, again, the focus on Microsoft, Meta and the other, of course, tech stories, Amazon as well, later this week in terms of how that builds out. And on the earnings story, we've had a couple of numbers coming through in terms of the story around Heineken and Philips as well. And Heineken is a reminder that the ripple effects of the China consumer continues to impact European stocks.
I mean, almost $1 billion yuan, euro. I'm going to fix my currency, but around 1 billion, I know, is the figure of an impairment charge. This is really fascinating because at the same time, they are actually lifting their profit growth target. They're actually spinning this out and saying, actually, we're doing fairly well. Their North American numbers coming in strong. But I wonder how the market will interpret this, given it is a one-time charge. But does that signal something more? Yeah.
Does it signal continued weakness in the Chinese consumer market? They invested over $3 billion in that key Chinese brewery a number of years back in 2018. You're absolutely right. It's a dollar figure in terms of $1 billion, close to $1 billion impairment. Do they look to change that stake, given the weakness in the Chinese consumer? You're right as well to point out the guidance up to 8%. How do they get there, I think, is a key question when we speak to executives from Heineken later in the show.
I'm excited to hear about the Euros. I want to hear about what the read-through to from the Euros is, from the Olympics, because we keep talking about this kind of consumer story, yes, from that point of view. There's plenty of sporting events right here in Europe as well that might feed into some of those earnings as well. For me, and I'm traditionally not the one to lead the charge on the UK coverage, but for me, I thought this was really interesting. We had some quotes coming out of Rachel Reeves over the weekend. She's due to make a speech today, and I thought some of the kind of excerpts that we had got were really fascinating. Simply this idea that she's saying, look, we've inherited some of the worst budgets since World War II, and surprise, surprise, it's even worse than we thought it was. That is not an encouraging statement, although I'm curious how much of that is a surprise, given we kind of knew there was no fiscal headroom, didn't we?
We did. It's just the scope or the narrowness of that fiscal headwind. You flagged this to the team over the weekend. The number standing out in terms of the reported number, this additional hole of £20 billion. That's the reported number. The speech, as you say, from Rachel Reeves later today, going to be really consequential. We'll get the timing of the budget announcement as well. Broke and broken is the line that is expected to come out in terms of the Chancellor on the fiscal challenges of this nation. And it reminds me of 2015, where the Labour Chief Secretary to the Treasury under Gordon Brown left a note for David Cameron and George Osborne saying there is no money left. It looks like Labour's trying to turn the tables on that front. But all the challenges, of course, of that £20 billion fiscal hole in terms of housing, in terms of defence, in terms of immigration. And that's going to be outlined later today, it seems, by the Chancellor.
See, this is why I needed you in the morning, because I did not do my British history homework over the weekend. This is very helpful. But what I did do is look at the pound, and the fact that we're still at a 128 handle. Is this the honeymoon phase for the markets for the UK? Do we start to see some sort of reckoning after some of these revelations, some of these numbers come out? So that's something that we're going to be talking about throughout the show. Let's talk about what else we've got coming up on the show today, including to kind of factor in some of that key week for central banks. Benjamin Jones from Invesco Asset Management will be joining us around the table. Plus, of course, we're going to come back to that earnings story. Tom was just talking about that. The CEO of Heineken joining us at 7:45 a.m. UK time. The Dutch broker, like we talked about, discussing a €870 million impairment. And of course, we are going to be talking about the Magnificent Seven. Can they indeed stay magnificent? We'll get the view from Wei Li, Global Chief Investment Strategist at BlackRock, in our next hour. Look, there's a lot to digest, and you actually flagged the story that BlackRock has been fairly positive on the tech rotation. We also flagged that you saw that the Nasdaq was in correction territory. Is this where, do they break some news perhaps on our show today?
Well, we always love speaking to Wei Li of BlackRock. They've been prescient in terms of how inflation evolves. They've been key on that. They've been out front suggesting that inflation is going to prove stickier. It's going to be harder to get down to that 2% target. And they've always consistently pushed back from very early on expectations you're going to get radical in terms of the number of rate cuts. But when it comes to the tech story, that really stood out. So Wei Li saying and putting out a note a couple of weeks ago and saying, we remain committed to mega cap US tech. That remains a key position. So, yes, I think that is a question for Wei Li and the team, given that we've seen the sell-off in some of those key AI names.
Yeah, and I think that this is where the earnings story really comes in handy as well, because we got those Alphabet numbers last week, and they weren't that great when it comes to the AI story. They were perhaps not even that great in the advertising space either. I'm curious whether if you get the likes of Microsoft, Amazon coming out and saying, well, actually, the cloud story is doing better than ever, does it kind of rejuvenate, re-energize some of that bid into tech, especially given how much of the sell-off that we've seen? So that's going to be a conversation we have throughout the show.
Yeah, does it offset some of those concerns about the huge spend that's coming through that seem to be the anxiety point for investors when it comes to Alphabet's numbers? Microsoft expected to ramp up their spending as well when they came out with their details and their earnings on Tuesday. So the market reaction to that spend around AI, of course, is going to be consequential. Here's what else you need to know this Monday morning then. Israel attacking Hezbollah targets in retaliation for a rocket strike that killed 12 children in Golan Heights over the weekend. Hezbollah has denied responsibility. Despite the attack, Prime Minister Benjamin Netanyahu has sent a top envoy to Rome to discuss a proposed Gaza ceasefire. This comes as Recep Tayyip Erdogan suggested Turkey may intervene on behalf of Palestinians, possibly with military support. Venezuela's electoral authority, which is controlled by the ruling regime, says Nicolas Maduro has been re-elected as president for another 6-year term. But speaking within the last hour, the opposition claim their candidate took 70% of the vote in tabulations. The US says it has serious concerns the result does not reflect the will of the Venezuelan people. And shares in Japanese drug maker Eisai tumbled the most in more than 18 months after European regulators rejected its Alzheimer's therapy developed with Biogen. Jefferies says it's a very big negative surprise since approval was expected. Its analysts say reputational damage from the rejection could still hurt the drug's sales even if it's approved on appeal. And I know this is a story that jumped out to you, Kriti, the importance around the rejection, at least for now, of EU regulators of this key Alzheimer's drug that's been approved in Japan, China and the US.
Well, this was a really big deal because we actually thought when this first came out from Biogen, and remember they are the kind of innovators in this space. Alzheimer's is not a drug, it's a disease that has been even cured or tackled by anyone. So this is a very kind of groundbreaking innovation. But what's important here is that the initial kind of pushback when Biogen first put this out came from the Japanese authorities because this is a partnership with Eisai, that Japanese company, of course. So the fact that it got approval from Japan, which is kind of known as a very strict medical regulator, of course we know that they all are, but got pushback from Europe is really fascinating, especially in the context. And these stories aren't really related, but in the context that when we talk about big tech getting regulated in Europe, this is a similar story. The European Commission, the CMA, has gotten in the way of some of these big deals because regulation has become far more a big part of the agenda in this part of the world. I'm going to kind of rope Biogen, even though it is a pharmaceutical story, as kind of a biotech company as well, because this is a company whose latest stock has really been tied to the success or potential success with this drug. So I thought this was fascinating. Of course, we know that showed up in the stock price back on Friday, a 7% decline in the U.S. shares, but you're finally seeing those shares in Japan react to it.
Yeah, is this, as you suggest, possibly regulatory overreach by EU regulators, or is it rational given what they say are these rare brain-swelling side effects of this drug? Jefferies also pointing out that about two-fifths of negative European regulatory approvals and rulings are actually reversed.
Yeah.
But to the point that we mentioned in the story, the reputational damage for this drug may already be there as a result of this ruling.
And we should mention there are some competitors that are already coming forth. Eli Lilly, for example, is in early stages of having their own candidate to tackle Alzheimer's, which, by the way, affects something like 6 million people in the States. So this is a really, really big story that a lot of people in the United States are, of course, following. So we're going to bring you more on that as we get that. But coming up on the program, Italian President Giorgia Meloni looking to rebuild ties with Beijing as she kicks off her first visit to China since exiting the country's Belt and Road Initiative. We're going to dive into what's at stake in that part of the world. Plus, train travel returns to normal in France after services were sabotaged ahead of the opening ceremony of the Olympics. We're live in Paris with the latest. But up next, U.S. Treasury Secretary Janet Yellen pushing back on Donald Trump's argument that a stronger dollar is actually hurting U.S. manufacturers. We're going to discuss that and more with Benjamin Jones from Invesco. As always, get involved in the conversation. If you have any questions of your own or for our guests, please send them to us on IB+BB TV Go. Stick with us. This is Bloomberg.
Over the last several years, the United States has had tight monetary policy. Interest rates in the United States have been higher than in many parts of the world. That's induced capital inflows that have strengthened the dollar.
OK, US Treasury Secretary, of course, Janet Yellen speaking at the G20, giving her rationale, unpacking the supportive factors for the US dollar. And I wonder if that view gets challenged in terms of dollar strength this week as we lead up, of course, to that crucial Fed decision later. Let's bring in Benjamin Jones, Director of Macro Research at Invesco. Ben, as we look ahead to that decision then, there's been a lot of build-up last week, really fascinating to get names like Mohamed El-Erian, but also Bill Dudley as well, suggesting that, or making the case that the Fed should even consider going this week. That is not the base case for these markets. No. When it comes to your expectation in terms of the Fed's next steps and the impact on the dollar, how much is priced in at this point? Give us your view.
So, I mean, I'm with the market. I don't think it will happen this week. If you'd had me on here 3 weeks ago, I would have said the first cut from the Fed would have been in December. I don't think there's any really need or reason for them to cut just yet. But I'm starting to change that view, and I think actually perhaps they do go in September. Not necessarily because there's a massive pressing need, but more because this is the best opportunity for them to do so. So when we look at the inflation profile, we see that a lot of the really good base effects are dropping out. Obviously, we know that services inflation is still quite sticky, but there's a little bit of a concern that goods inflation starts to tick up a little bit towards the end of this year, and that starts to just lift those overall inflation measures. So if that starts to happen, it's then going to make it harder for them to Fed to say, well, we're going to cut in December, but we didn't cut in September, even if those inflation numbers are that little bit higher. So I think maybe actually September is the time that they go.
So that warning on inflation and potential tick up in terms of goods inflation later this year is really interesting. You did not mention a single word on jobs in that answer. And that, of course, was the point of Bill Dudley and Mohamed El-Erian. They are seeing softness in the labour market. We're going to get an on-farm payrolls print at the end of this week. Expectations of around 178,000, unemployment at 4.1%. Are you not seeing that sort of, what are you not seeing that they are seeing when it comes to the labour market? Or what is it that they're missing?
It's a really good point. I mean, the labour market, you can point to parts of the labour market where there are certainly cracks. I mean, probably 18 months ago, I was talking about the temporary services payroll numbers rolling over. That's normally a really good harbinger of overall payroll numbers falling over as well. But that hasn't happened. There's been this sort of real gap, this jaws opening up between the two of them. So, look, if the labour market does roll over in a significant way, I'm going to change my view. I'm going to get more sort of dovish on the Fed. But I just don't really see it at the moment. If we look at things like hospitality and leisure areas, there's still a dearth of employees in that region. It's still running below the pre-pandemic trend. So there's still plenty of jobs out there for people to go for. So, no, I think actually the jobs market, yes, there are cracks, you can point to them, but this is such an unusual cycle coming out of the pandemic that actually I think the labour market remains pretty resilient going into the end of this year.
So that's what's going on in the States. Let's talk about what's going on the other side of the Pacific, if we can, and specifically in Japan, because we also have the BOJ meeting on Wednesday. A hike largely expected. You're already seeing some really strong appreciation in the yen as well. And I'm curious how that eats into things like the carry trade, which has been such a juicy alternative for people who can't find yield right now in the stock market or in the bond market. How do you play it?
So actually, I think the yen goes back to its sort of weaker stance over the coming weeks. I can't see 15 basis points from the Bank of Japan really changing that carry trade. I mean, it's so wide that I don't think that adjusts. The other thing that I think is a headwind for the yen going forward is just the sheer capital outflows from Japan. This policy shift and this change in backdrop that we're seeing in Japan means that many domestic investors, be they households, be they people like the GPIF, for example, are looking at their portfolios and thinking, we need to reassess, we need to rebalance. Now, part of that is on the basis of very, very strong domestic equity performance, they're going to want to rebalance that and move capital overseas. That's going to be a headwind for the yen.
So when you square that with what you're seeing with the dollar, and I think this is where, let's put the fundamentals to the side for a second and talk really about positioning, because I think that's more what's happening here, to your point on capital flows. When you talk about kind of the capital, or I should say the risk gauge of haven currencies, I'm trying to phrase this correctly, because I think one of the most kind of interesting dynamics I saw lately was with the Trump trade, and that we saw it kind of show up in the FX market a little bit. And we saw this bid into the yen and this bid into the Swiss franc when kind of U.S. politics comes to fruition, which we don't really see in the stock market. And I think what I find interesting is, where does the dollar fall into that? Is it still that global haven, or is it still far too sensitive to the U.S. political situation, and I would argue the deficit situation, for global investors to really pile in?
Yeah. A bit of everything is the really sort of weak answer to your question.
You got to pick one.
So, look, I think it is still the safe haven. It's not going to lose its reserve currency status anytime soon, I don't think. In terms of the Trump trade as well, I think that really is very mixed. I think you can pick out days where it feels like it is the Trump trade that is driving rates and driving the dollar. But then you get a big piece of fundamental news like the CPI print, and then all eyes are focused on that. So certainly the politics and the Trump trade is not something that you can trade consistently, in my view. In terms of my view for the dollar for the rest of this year, I think marginal strength from the dollar coming through. I think it comes from weakness in the yen. I don't think it comes from weakness in sterling. I think actually sterling slightly appreciates against the dollar going forward. So it's going to be a more mixed trade into the end of this year is the way that we're positioning at the moment.
Tom, he used that word sterling, which I think is so fascinating. The fact that the cable is kind of the safe haven right now, at least in this part of the world, I think is weird and fascinating and very helpful for me.
And for your holiday travels.
Yeah.
I think we'll take that. But yeah, the move's higher for yen and sterling. The yen's up since its 1980s lows. It's currently up about 5% since the lows that we hit. The pound is doing quite well at 128. There are some forecasts out there you could get to 135 on the pound. So that takes us to the BOE and that decision. And what jumped out for me from your notes were a couple of lines in terms of package holidays doing really well. So maybe Kriti's a factor there. And then there's Taylor Swift. And then there's a BOE decision. And then you're suggesting that maybe if you cut, that could actually be disinflationary. Lead us up to your views on the BOE and what it means for pound. Is there too much priced into the pound at this point?
I don't think there is too much priced into the pound, actually. I mean, I think you've got to think about where we've come from. We've had many, many years, and I've really been on this sense of being very, very pessimistic about the UK. And I think that pessimism has overshot. And what we're seeing, actually, is the consumer is not in quite such a bad state as many of us thought.
Is it a safe haven currency?
I don't know if I'd put it as a safe haven currency. I still think it is somewhat of a cyclical
and what's the next level you're looking at?
Actually, sort of 135, but that's over sort of the 6 to 12-month view, taking the sort of medium to longer-term view. I think that's where we get there. But it kind of is this sort of grind higher as some of that good news comes through. In terms of what happens with the Bank of England this week, look, it is very much 50-50. But again, it's similar to the Fed, I think. We can probably look through some of these recent inflation numbers and think actually perhaps there is a little bit of a tick up towards the end of the year in inflation. Now, services inflation, you mentioned Taylor Swift, you mentioned the package holidays that I've been talking about.
Are you a fan? I think it's the
I'm not. I couldn't name you a Taylor Swift song, unfortunately. So
well, we're
I much
would
like to get some lyrics in here. I'm not going to be able to do that. But in the serious point, if you look at the services level of inflation and you say, OK, it's quite sticky, it's quite high, that's a reason for the Bank of England not to cut rates. Well, if you dig into the detail, there's quite a lot of dispersion within services inflation. So package holidays, hotels, for example, driven by Taylor Swift, for example, that's where you're seeing the strongest level of inflation. Whereas there are some other measures of inflation in the UK. Canteen prices, who would have thought there was an inflation number for canteen prices? That's actually negative territory right now. What I think that reflects is this idea that people that have money sitting in their bank accounts right now are thinking, this is fantastic. I'm getting a decent return on that. I'm going to go out and spend it. So that's retirees, that's people without a mortgage, for example, which is why I think that if you do get a bit of a cut in rates, you perhaps get just a little bit of just taking the heat out of that part of the market. Whereas to take rates down by 25 basis points in the US or in the UK, that's not going to make much of a difference to mortgage rates. That's not going to make much of a difference to people to go out and buy new homes. So I think that's potentially where the heat is maybe going to come out a little bit. No, it's not going to be that inflation is going to tank on the back of that, absolutely. But it just takes a little bit of the heat out of some of those sectors, in my view.
All right, Benjamin Jones, Director of Macro Research over at Invesco, we thank you so much. Tom, it's interesting the point that he's making here when it comes to the vacation travel and the Taylor Swift and all of that, because to me that's all factors into the monetary, and then I'm trying to avoid the Guy Johnson Taylor Swift obsession here. But the fiscal is really interesting because the other side that Guy Johnson tends to argue all the time is that so much of the outperformance in the States and even in Italy and other places has to do with more of the fiscal spend. But in the UK, there's no room for that fiscal spend. Isn't that the whole point of this speech that Rachel Reeves is going to make?
So it takes us back to that FT piece that you sent out to us over the weekend on Rachel Reeves and the speech later, and to whether or not they're going to have to sideline the hospital builds and the infrastructure builds that they had planned already, that the previous government had planned because of that £20 billion fiscal hole. So what does that mean? Yeah, less fiscal input coming through for the UK at a time when maybe we're looking at a cut coming through, if not this week, then next. And here's one for Ben then. Basically, what Ben is saying is that the Central Bank of the UK should just shake it off when it comes to Taylor Swift. I'll give you
well done. T-Mac coming in with the Taylor Swift references. Coming up, we're going to have a little bit more fun with some of our stocks to watch, including Heineken, the Dutch beer giant, narrowing its guidance following that nearly $1 billion impairment charge. That and more next. This is Bloomberg. 30 minutes from the start of the opening trades across Europe. There's a lot going on, from the markets to, of course, the earnings we're expecting, and, of course, the geopolitics weighing over all of it. And that's where I want to go next. Israel is threatening further retaliation after striking Hezbollah targets in Lebanon. It comes after a rocket attack that killed 12 young people, children and adults included, in the Israeli-occupied Golan Heights. Hezbollah has denied responsibility for the attack. I want to get more on this story. Joining us now for more is Bloomberg's Jumana Bersetchi, joining us out of Dubai. Jumana, a lot going on, a lot of different factors. Walk us through the latest.
Yeah, Kriti. Well, the events over the weekend mark the biggest escalation we've seen in Israel's northern border since October 7. And just to recap what happened, a rocket exploded on a football field on Saturday afternoon, killing about a dozen youth aged between 10 and 20, wounding more than 40 others. The IDF were quick to point the blame at Hezbollah, saying that that type of rocket that was fired could only have originated from Lebanon, which is, of course, where Hezbollah, the militia, is based. Now, Hezbollah have denied responsibility for attack, but then we got comments from the U.S. Secretary of State, Antony Blinken, who said, this is a quote, "There's every indication that this missile has been fired by Hezbollah." The attack also meant that the Israeli Prime Minister, Benjamin Netanyahu, who had been in the U.S. over the course of the last week, cut his trip back to Israel short, and he had to meet with the rest of his war cabinet to discuss a potential reprisal. Now, over the course of the day yesterday, we did see limited strikes on specific Hezbollah assets within southern Lebanon. But there is concern, growing concern amongst the international community and within Lebanon itself, that Israel is prepping itself for an even bigger reprisal. Unknown what format that's going to look like. But what we do know is that many within the Israeli cabinet are now pushing for a more forceful response to the attack over the weekend in the Golan Heights. The Lebanese prime minister is urging restraint and has said that he would like to see a comprehensive ceasefire in southern Lebanon and a full implementation of UN Resolution 1701. That was a resolution put in place after the 2006 war to avoid escalation. But definitely the next 24 to 48 hours are going to be crucial.
OK, so once again, very, very tense moment in the Middle East. What do we know? What does this do? How does this play into those ceasefire talks then, Jumana, when it comes to the conflict in Gaza?
Well, it's a very important question, Tom, because all of these things are interlinked. So while the possible retaliation to the Golan Heights attacks was being discussed within Israel, at the same time, the Israeli chief negotiator was in Rome meeting with the CIA director, William Burns, alongside the Qatari prime minister, the chief of intelligence from Egypt. Remember, Egypt and Qatar have played a major role in these mediation discussions, all talking about the negotiations that should ultimately lead towards a ceasefire. And again, this comes on a more promising discussion that the Prime Minister Netanyahu had with President Biden last week in the White House, where they talked about positive talks that are taking place on both sides towards the potential to getting that ceasefire over the line and securing, this is most important from an Israeli perspective, the hostages that have been held in captivity since October the 7th. Now, of course, the backdrop here is that there have been many stumbling blocks along the way from both sides on how you move from a temporary ceasefire to a permanent ceasefire, what happens in the post-war phase, and whether or not, to Israel's point, Hamas has been fully de-radicalized and demilitarized. So those will continue to be key sticking points. But as it pertains to the rest of the region, it seems unlikely that these other fronts that are opening up, whether it's with the Houthis or with Hezbollah, that things can actually calm down in the absence of a ceasefire. So one would, in theory, lead to a de-escalation on other fronts as well.
OK, Bloomberg's Jumana Bersetchi with the latest out of the Middle East. Thank you very much indeed. Let's switch focus now and bring in our Markets Live executive editor, Mark Cudmore, who we, along with his team, of course, has been kept very, very busy this week. Mark, what a week for these markets. The central banks, of course, will be playing that prominent role. When it comes to the question of the Fed, Bill Dudley, Mohamed El-Erian last week saying they should cut this month. Would that smack of panic? That is not the baseline. That is not the base case for these markets right now. But would that be a move of panic from the Fed?
Good morning, Tom. Yes, I think a cut this week would alarm markets. I do not expect them to cut. While they're trying to step away from forward guidance, they're not yet in a world where they want policy to seemingly be completely random and shocking. And the fact is, we're pricing on a very, very small probability of a cut this week. So I think if the Fed suddenly did that, it would worry people about what do they know that people don't know. And also, I don't feel that the economic evidence justifies a cut quite yet. In hindsight, a couple of months from now, we might say, oh, yes, it was clear. But the indicators are pretty mixed. Yes, there's still a disinflationary trend, but we know we're through some of the best of the base effects and that the second half of this year will be a bit harder on the inflation front. And while there are cracks in the labour market, a lot of economic indicators are not showing an economy that is that close to a recession. Even Claudia Sam herself, who created the so-called Sam rule, said it does not look like a recession is imminent in the US, and therefore I don't think the Fed cuts, and I think this week we'll probably see US yields move higher in the front end.
So whereas a cut may be, if not immediately, at least on the horizon for the Federal Reserve and arguably the BOE, Mark, the BOJ going in the exact opposite direction. Consensus actually expecting a hike coming on Wednesday. How does this catch markets off guard, if at all?
Yeah, I think the BOJ will confuse and disappoint. It's what the BOJ tends to do, confuse and disappoint. At the moment, going to this meeting, there are very hawkish expectations priced, and the shorts, the weak-handed shorts at least, have been cleaned out of this trade. The economics just don't justify a very hawkish message, given that growth is, the economy is practically stagnant, evenly with deeply negative real yields this year. And inflation, sure, it's just above target, but is it sustainable? That is very much debatable. So I think if the BOJ hikes, it'll come with a dovish message which undermines it, or else they may not hike at all. And I think ultimately after the meeting, we'll see the yen start weakening again, because long-term fundamentals are still very much against it, at least on the crosses, even if the dollar is a different trade.
Mark, just briefly on the MPC, do the hawks fold their hand when it comes to this week's decision?
I'm biased to think that the BOE doesn't cut. But I have to say, this is a coin toss. There's not really any edge here. This is not one where, you know, if I was still trading seat, that I'd want a position for that. And I'm also worried about the fact that the market, the speculative market, is long sterling at the moment. So therefore, if they do cut, they'll, even though it's slightly better than Even's pricing of a cut, it'll really deliver an impact in the currency market as well. So look, BOE is a coin toss. What's interesting, though, is a tail risk. We want to look for a guide in that. The Australian CPI print out the day before might influence what the BOE does, because it'll indicate on the global disinflationary trend.
All right. Central banks around the world in about 3 minutes with our Marcus Live Executive Editor, Mark Cudmore. We thank you so much. You can get more from him and the team. All you have to do is type in MLIV GO on your Bloomberg terminal. Let's go from the macro to the micro and get our stocks to watch with Joe Easton. Joe.
Morning, Kriti. So starting with Philips, the company reports its first order intake gain in 2 years, driven by sales growth over in the US. And earlier today, the CEO of Philips spoke to Bloomberg about that growth in North America.
The strong order intake actually was from a very strong North American performance, but also we see growth in other pockets of the world. So actually we see that the strength in our innovations really rallied, orders coming in from across monitoring, imaging, interventional, and also very strong enterprise informatics. So we see that momentum in healthcare growing, and that's very encouraging.
So that was the Philips CEO speaking to Bloomberg earlier about that order growth. But the big weight on this stock has been the recall of their sleep apnea machines. We can see a massive drop in this stock over the past few years, down 34% over a 3-year view. But this could potentially be a bit of a relief for the company, and they are actually seeing lower than expected claims on the sleep apnea issue as well, so a double positive on that one. Then moving over to the beer space, we've got numbers from Heineken, lower than expected organic growth from the company. European sales actually declining in the last period on an organic basis, and they've also booked a big impairment related to one of their Chinese businesses that's seeing slower than expected demand. The impairment almost 880 million euros. They do say that is due to weaker demand on that one. We can see this stock not really done much over the past few years, pretty stagnant, but most analysts expecting a bit of a rebound. 16 buys, only 2 sells on that one, so pretty positive outlook in terms of analysts. Then we've also got a bit of negative news on Reckitt Benckiser. Now, a jury on Friday awarded a big sum to the family of a child that got a bowel disease from an infant formula and later did actually get brain damage from this product, according to the jury. Now, this is likely to depress sentiment for both Reckitt and Abbott Labs, the 2 companies that made the formula, and it follows a 60 million award against one of the Reckitt's businesses, Mead Johnson, back in March. That caused a massive slump in the share price. It's down very heavily, and this is seen as another weight on the stock today. Reckitt, we can see there's that big drop when the jury awarded 60 million. The award today, almost $500 million was awarded to this family. It's expected to be negative. Keep an eye on Reckitt in London this morning.
OK, thanks to our equities reporter Joe Easton walking through some of the stocks that could be moving this Monday at the open. Just 20 minutes away, of course. And coming up, Heineken, as Joe was saying, narrowing its guidance after taking a nearly $1 billion charge linked to that weak demand picture in China. We're going to put that question in terms of how that story unfolds to the CEO, Dolf Kandenbrink. That is next. This is Bloomberg.
We're just about 15 minutes away from the opening trades across Europe. You're seeing futures broadly higher. How much of that is just some sort of paring back or paring some of the losses we saw last week as well? How much of this is actually good sentiment or even autopilot ahead of what's going to be a crucial week in terms of central bank decisions and earnings stories as well? And speaking of those earnings stories, let's go to one of our top ones coming out this morning. Heineken has taken a one-time impairment of more than 870 million euros for its stake in China's biggest brewer on concerns over consumer demand. Now, the world's second largest brewer also narrowing its forecast for its full year operating profit. Let's get a little bit more insight on some of these numbers and bring in the CEO of the company, Dolf van den Brink, joins us around the table. Well, I was going to say around the table, but next time you'll have to join us around the table, Dolf. This morning you join us down the line. Walk us through some of these numbers, especially when it comes to this impairment charge. What should our audience know about this?
Very good. Good morning, and thanks for having me from Amsterdam, indeed. Before talking to China, if you allow me very shortly, we are very pleased with our first half performance. Beer volumes up 2%, revenue up 6%, operating profit up 12.5%, so very good operating leverage there. Broad-based growth across our 4 regions, and the quality of the volume growth was very good and important, with beer volume up 2, premium volumes up 5, and the Heineken brand up 9. So we had a very solid and positive first half of the year. Also, we are quite pleased with our China partnership. The impairment that we had to take, a non-cash impairment, is a technical adjustment that we have to do. Because as a minority participation, we need to value this on the share price, and the share price of CRB listed in Hong Kong dropped below the level that we acquired the company or the stake in back in 2019. We don't believe this is a fair reflection of the underlying operating performance. Since we took the stake in 2019, the net profit of CRB has gone up by 300%. Brand Heineken's volume have gone up by 400%. Also, year to date this year, the Heineken volume in China is up 25%. So we're very pleased by the performance of the unit, but we had to take this non-cash impairment as a technical adjustment.
So, Dolf, then walk us through that broader consumer story, because there's a lot of analysts, a lot of investors that are waking up this morning who are looking at these numbers and saying, well, how much of this is a broader China story, given that in other sectors across Europe and across the world, Chinese weakness is a broader theme. How much of that eats into your bottom line?
Yeah, we are actually very pleased to see that broad-based volume growth with modest pricing across the world. We still have high pricing in Africa due to devaluations and local inflation. If you take that out and look across APAC, across Europe, across the Americas, we see much more modest pricing than we have had in prior years. And that really allowed for volumes to bounce back. We are really looking for that kind of balanced growth of our revenue between volume and revenue per hectoliter. Key markets like Mexico, Brazil, very pleased with mid to high single-digit revenue growth. India, very important, high single-digit growth. Last year, we really challenged in Nigeria, where I'm proud of how our teams are navigating some of the local volatility, but volumes up high single-digit. So our key major markets outside of Europe performing well. In Europe, we saw volumes, beer volumes slightly up, pricing slightly up. Year-to-date May looked better, but we took a bit of a step back in June. We were expecting in June, July upside from the sports events, from the cycle of last year. That unfortunately didn't materialize. We believe mostly due to weather being much worse than we were hoping. You saw that particularly impact Northwestern Europe, East Central Europe doing better in that regard. But in the aggregate at the half-year mark, we're very pleased by that 2% volume, 6% revenue across our global footprint. We remain cautious. Indeed, consumer sentiment, particularly in developed markets like North America and Europe, are still a bit subdued, we would say.
Yeah, well, it's really fascinating that sports wasn't a catalyst for the business, but as you say, you're blaming the weather on that front in Northern Europe. What are current volumes looking like right now, Dolph, in the current quarter?
Yeah, we're always cautious to make those statements. We will update the market at the first or at the third quarter update end of October. What we did say in our release that some of that subdued volume in June was flowing out, over into July, and we believe mostly weather related. As I said, year-to-date May, our volume and revenue growth in Europe looked very promising. We're very happy to see that. We took a bit of a step back in June and now July. We still have good, prospects for the remainder of the year. We believe indeed it's quite important that we keep the pricing modest to allow the category to regain its affordability. We're also making a major step up in our marketing and selling investments in the second half of the year, as we really intend to propel growth in the second half and the years to come.
Is that caution on pricing? Does that indicate you're seeing a little bit of softness? You're seeing a consumer that it is a little bit more conservative right now?
No, well, I think it has most to do with the recent past. Over the last 1-2 years, we and others, the industry, have had to take disproportionate amount of pricing due to incredible input cost inflation. That impacted our volumes last year. We had negative volume growth in our European markets last year. And that's why we're very happy to see volumes bouncing back, slightly up in the year to date, with pricing revenue per hectoliter still slightly up. That's a good place to be, because it's really about stabilizing the category in that kind of market, and then still a lot of growth coming out of our global footprint.
So, Dolph, let's zero in on that pricing conversation as well, specifically in the States, because one of the conversations we're hearing, at least on the consumer front out of the UK from the likes of Nestle, Unilever, et cetera, is that as the volumes drop, the pricing is what's making up the difference. I'm curious how much headroom you have that should your volumes drop, how much room can you actually raise prices, specifically when it comes to the American consumer?
Yeah, we are a relative smaller player in the US market. Our depletions to retail were down low single digits. We outperformed the market a little bit. So indeed, we still see a little bit of a subdued consumer in the American market. I think for us, control the controllables. We're deliberately keeping our pricing modest, but still in positive territory. And what's most important is invest in our brands, in our portfolio. Premium beer continues to do very well, up 5% at the half-year mark. Brand Heineken up 9.2%. Very important, and there's a lot of momentum there in 0.0 beer. We are by far the global market leader. We calculated that we captured around 50% of the growth of the segment over the last 5 years. With Heineken 0.0, we have the #1 0.0 beer brand on the planet, up 14%. So it's control the controllables. Invest in our brand portfolio, invest in premium beers, invest in 0.0, and that is what we will focus on going forward.
All right, so Dolph, let's then talk about one of your competitors, if we can. Carlsberg is venturing in to the soft drink space. Is that something you would consider, broadening out beyond beer?
I cannot make statements, on future M&A. We are selling soft drinks in different parts of the world. We are proud to be, soft drink bottlers in part of our global footprint. When it makes sense in local markets, we will, proudly continue and contemplate that kind of diversification. But we remain first and foremost a beer company, a beer and cider company, and we believe there's still a lot of embedded growth to unlock. And again, that's giving us the confidence to plan for this material increase in our marketing and selling expenses in the second half of the year and going forward.
Well, we look forward to seeing how that all plays out. Heineken CEO Dolph van den Brink will have to leave the conversation there. We thank you so much for joining us this morning. He's making some interesting points there. When we're talking, Elise, this morning about what that China read-through looks like, what even the sporting read-through it looks like. He was talking about the Euros, but we have the Olympics as well. And I'm curious what we're not seeing. What is the market not seeing in terms of these broader macro trends that maybe the beer market is?
Yeah, I mean, it's such a good gauge in terms of the health of the consumer. And I thought what really stood out as well was his relative caution when he talked about pricing and not wanting to push through significantly higher prices. And that, to me, suggests that they are seeing a bit of caution around that consumer. He says the premiumization play continues, zero alcohol beer as well. But they have, in terms of the guidance, full year profit range, 4 to 8%. So how they get to that 8%, the stars are going to have to align. But really fascinating, as you say, that the sports story and that component didn't come to play for them in the early part of the summer because of the weather.
Yeah, and if you look at the analyst commentary this morning, they're saying that they're already performing at the top end of their guidance. So does that set up perhaps a little bit more pain down the road? Coming up, it is the market open. We'll see how Heineken shares perform alongside many, many others. Futures are pointing higher. A little bit of optimism in the water this morning. Stick with us. This is Bloomberg. A few minutes to go into the opening trade. You are seeing a little bit of green on the screen, but it's interesting that it's coming off of what we saw in Friday's session. Let me walk you through what the markets actually look like, because we are seeing in the European session on Friday, you saw green on the screen, just the party continuing over into the U.S. session until that crucial PCE number came down. The fact that inflation may actually be higher instead of lower kind of threw markets for a little bit of a loop, but you still saw them end in positive territory. That is significant given what we are seeing in the futures picture this morning. Green on the screen across the board. And I'm curious what that looks like, especially given we have so many earnings, so many central banks this week as well. Tom, there's a lot to digest when we look at this market, because it's not just a marginal move higher. We're seeing something like 0.5% higher on Eurostoxx 50 futures, FTSE 100 higher by 0.4%, even over in the States, 0.5% higher. And I'm very curious what's driving that, Tom.
Yeah, $10 trillion worth of market cap tech names reporting this week, kicking off with Microsoft, of course, on Tuesday. So the tech earnings story is going to be fascinating as we layer on across, of course, the central bank action. And talking of earnings, front and centre, some European names, of course, reporting today. So we keep an eye on some of these stocks at the open, including Heineken. We're just speaking to the CEO, sounding relatively upbeat. But from Citi's perspective, the results that crossed, which were a mess, are slightly disappointing. That's the quote from the Citi analysts, noting both the negative recent trading momentum and the lack of positive optionality. Heineken looking at profits full year of between 4 to 8%. Philips coming through with a better set of numbers, working through some of their sleep apnea challenges. So we watched that stock at the open. And Reckitt facing some charges that could prove awaits. Kriti.
Yeah, there's a lot going on. Let's see if that futures, at least the optimism you're seeing in futures, matches some of those perhaps negative earnings stories that you just pointed out, at least seeing what those weights actually look like. I think what's going to be interesting, though, is when we do see those opening trades, and we are still waiting to see, again, a few of them, we are going to see what that actually looks like. Tom, I'm going to throw it back to you because I feel like you have maybe a little bit more live pricing right now than I do, especially when it comes to the FTSE 100.
Let's check in then on the FTSE 100. As you said, futures pointing high. Currently, the UK benchmark adding 38 points, up around 0.5% at 8,329. And that's despite the fact that commodities are not performing so far in the session. So we'll look at basic resources. But it's the earnings story, really, that's front and centre in terms of the European session as we lead up, of course, to the details out of the US as well. So the FTSE 100 currently in positive territory, up 0.4%. In terms, 0.6%, I should say, sorry, adding 46 points. And in terms of the breakdown, sector by sector, we'll get the details, of course, as the other main indexes start to open. Heineken, we are waiting for the print there. I'm currently seeing some downside, given the details that came through. Heineken, I'm seeing a drop there of 5.5% so far. We're also getting a print coming through for Pearson, listed here in the UK, down just shy of 3.6%. That is the publication company, of course. But Heineken is the biggest loser so far in the session. Early doors, of course, we'll get further prints on the other major indexes. Over in France, the CAC going on, of course, where the Olympics continue down, gaining 0.3%. It's a positive picture so far in the first few seconds for the CAC going over in France. The FTSE MIB also adding 0.7%, up 227 points in Italy.
Yeah, I'm just going to highlight very quickly. You mentioned some of the individual movers there. That from a sector perspective, oil is actually the outperformer this morning in terms of index contribution when you look at the FTSE 100. Shell, for example, your biggest index contributor to the upside. And I think that's really interesting, given that you're actually seeing a very broad rally this morning. And I'm curious how much of that is just a little bit of calm, maybe before the storm of later in this week. And it's going to be fascinating, given that, I mean, you pointed this out, top of mind, tech earnings maybe just might move the market more than the central bank earnings.
Yeah, and we're going to be speaking to Wei Li from BlackRock very shortly on the tech story, because BlackRock remains constructive on that space, despite the fact that you've got, of course, a drawdown in terms of the market moves around the Nasdaq, around 8%. Well, let's bring in Wei Li right now. Why keep you waiting? Why keep you on tenterhooks? I was trying to build up a bit of tension there. Wei, thanks for joining us this Monday morning around the desk. Let's start on the tech story then, because you and the team at BlackRock put out a note a couple of weeks ago saying we remain constructive, mega cap tech. The fundamentals are still there for this story, and you are expecting the earnings to come through and support that view. Is there any reassessment going on, given that pretty aggressive rotation out of tech that we've seen in the last week or so?
Good morning. Thanks for having me. I think we're definitely seeing a little bit of an air pocket, especially if you look at market movement last week. It has been driven by stretch positioning, summer thinner liquidity, corporate buyback blackout, as well as stronger yen that has been associated with the funding leg of global carry. So when that strengthens, actually, that unwinds some of the more popular positions. But as you said, Tom, fundamentals remain very strong, especially for tech. If you think about earnings expectation for this quarter, tech sector is expected to grow earnings by 18% on a year-on-year basis versus US ex-tech 2% for the overall market. And of course, right now we are almost halfway through, 40% through the earnings reporting season. Actually, U.S. equity market is tracking higher than expected. It's tracking 12% year-on-year growth versus aggregate 9% expectation at the beginning of the earnings season. So fundamentals are strong, but there are powerful technical factors at work that are really kind of creating a bit of an air pocket right now. But the big picture remains that the demand for AI build out the semis and the chips is really significant. We're at the beginning of this upcycle, which is why we remain committed in our conviction.
So what is your response to clients who say, look, we are concerned about ROI. We're concerned about the return on investment of this CapEx that's being spent. We see that from Alphabet spending about $13 billion in the last quarter. Microsoft expected to ramp up their spending as well when they report numbers tomorrow. What is your response to that the ROA is not matching that investment right now?
I would say, though, investment always precedes profitability. That has been the case in previous tech revolutions. That is the case right now. What we're seeing right now is that actually the time between investment and turning around profitability is shorter than previously, right? You look at AWS, it took 8 years before it turned around profit. So right now, in terms of the tech names, the big tech names, they're already turning around profits, not so without too much of a gap since the initial investment. The broader patience is needed, though, when we're talking about the broader market. So AI companies and big tech companies, they're turning around profit, but other sectors that are starting to upscale their AI integration, it will take longer for them to kind of turn around profit, which is why as we think about the implementation of AI, we're thinking about a concentrated AI story starting to broaden out, but we're not leaning into this broad rising tide lifting all boats type of story, which is very much catalyzed by the weaker inflation print, CPI a few weeks ago, and now markets getting excited about more rate cuts coming.
Wait, hold that thought. I just want to bring some breaking headlines here when it comes to the earnings story of Heineken. It looks like it is officially open coming in out of Amsterdam. The shares initially fell about 6.3%. They've now pared back some of those losses, but still down over 5%. This comes after that, of course, that China impairment charge. We just heard from the CEO saying, look, this is a technical adjustment. This is a one-time thing. But he was also talking a lot to us in the last hour simply about that consumer story. And Wei, I want to bring you back in here when it comes to that consumer picture, because in the earnings season that we've seen so far, at least here in Europe, we know that there is that China weakness that seeps through into this region. On the macro front, you're starting to see those early signs of the data showing American weakness as well. Does that just put Europe in a lose-lose situation, in your view?
Well, so far, earnings season has shown strength for U.S. equity market, especially relative to European equity market, which is why we have had the preference for U.S. over Europe for a while, and that is being borne out by the relative earnings strength. You talked about the consumer relative resilience. I do think that is a global story. You talked about the U.S. Chinese consumers. You talked about European companies being affected by not so robust Chinese consumers coming back. That is one theme. But if you look at the latest GDP print in the U.S., that has shown consumers cooling down a little bit, but that is being offset by greater spend on equipment for AI. So already we're seeing these themes coming through, which is the consumers are kind of passing the baton to AI spend as consumers run down their pandemic buffers.
But even though we see that resilience, how much room does it have to run? Because another conversation we keep having with CEO after CEO is around pricing and whether or not this consumer globally, yes, it may be strong, but can it really digest another, say, price increase on basic consumer goods, let alone things like beer and sporting events?
Yeah, so consumer strength is not something that we are extrapolating. So which is why as we think about kind of a broadly still okay growth picture, we're not forecasting recession, for example, but it's a differentiated story within that sectors and drivers of growth that are benefiting from secular tailwinds like AI, like other mega forces like the low carbon transition, are better supported than cyclical kind of parts of the economy that are very much still kind of benefiting from the tailwind of the tail end of the tailwind of the kind of the pandemic restart. So we're very differentiated in terms of how we're thinking about equity implementation.
Just briefly, looping back to the rotation story, and you've explained your position around tech really, really clearly. What does that mean for the rotation theme then? It's been pretty aggressive in the last few weeks, that shift into small caps, into cyclicals. Would you follow that, or would you sell that trade? What would you say to investors who want to follow that rotation trade? Does it have legs, essentially?
It depends on the time horizon.
Yeah.
The biggest event of the earnings season is NVIDIA, and that is not happening until late August. So from now until late August, we're talking about a confluence of factors: election headlines, thin liquidity, still very strong Japanese yen. We're heading into what is likely a live meeting, a BOJ live meeting this week. So when you have all those factors together, if you have a very short time horizon, yes, rotation, the momentum can go. But we have, for our tactical asset allocation, 6 to 12 month horizon. And over that horizon, we still think that fundamentals will prevail. And we have no reason to think that tech earnings wouldn't.
It sounds like you think NVIDIA could kill off the rotation.
No, actually, I think NVIDIA would support. Yes, it would support tech momentum and ultimately kind of reinforce the
rotation trade hits the wall that is NVIDIA.
I would say more about NVIDIA would support the conviction to tech, but if that actually kills off the momentum for the broader market, it depends on actually the broader macro backdrop of rates and inflation dynamics. So right now, markets are pricing 7 cuts from now until the end of 2025, which is very much extrapolating recent repricing momentum. We will lean against that a little bit because, yes, right now inflation is falling, goods deflation is still kind of bringing down overall inflation picture. But heading into next year, we're talking about fiscally expansionary policy. We're talking about structural constraints, still likely going to see inflation settling at a higher level compared to before. So high for longer is what we're positioning for, but markets tend to over-extrapolate both on the way up and on the way down, and that's what we're seeing.
But I'm curious then, and it feels like every time we talk about tech, everyone keeps asking, okay, well, do you buy it then? If there is this massive CapEx spend that you're really getting from the likes of NVIDIA, from even Apple and Microsoft, et cetera, traditionally in any other sector, this kind of massive upfront cost wouldn't necessarily be a positive for the stock. And yet, it's the opposite for tech. It's being viewed as kind of R&D, et cetera. When does it catch up, especially if we don't see a ROI in the next, say, 12 months, for example?
I would say we're talking about upfront cost for the whole economy, not just the tech companies. We're talking about AI upgrades for sectors like industrials, healthcare, financials, and for the broader economy as well. And that represents kind of right now demand for the semis, the chips, the GPUs, which is why we have no reason to think that likes of NVIDIA is not going to deliver versus the very elevated expectations. This is the 6th quarter now since the kind of introduction of ChatGPT to everybody, and it's no wonder that people are feeling a little nervous, right? I remember back in April, the beginning of the last earnings season, everybody was feeling very nervous as well, and markets were feeling very nervous as well, and those tech companies, they delivered, and markets kind of went back on track.
You know, Tom, I was reading a story also in the FT, I believe, about how JP Morgan said that they no longer need that their internal GPT, whatever that they've created or AI product can replace the job of a research analyst. I thought that was, I literally thought of you. I was like, I wonder what Tom has to think about that.
Oh, I thought you were saying you literally thought of me because he's very replaceable by
and therefore Tom is here.
ChatGPT. No, that is a really fascinating story. Really important, of course, for our viewers in terms of how investment banks are replacing or at least maybe augmenting the role of analysts with some of these AI functionalities. In terms of, let's get back to, I thought it was really interesting as well in terms of your views around the rate trajectory. You still think higher for longer, and you push back against the market views that you get 7 cuts by the end of next year from the Fed. What does that mean for the yield curve? Because we've seen the steepening of the yield curve. Is that overdone?
Well, we still think that the yield curve should steepen, but that's not so much around kind of what happens to the front end, which is high for longer, but it's more to do with what we think the back end is going to do, because we think term premium, currently still close to zero, is not appreciating the fact that the U.S. economy is facing steeper fiscal trajectory no matter who gets in the White House. We're talking about significant spend coming from the low carbon transition, coming from greater defense spending, coming from all sorts of things, higher interest payment as well. So when you bring all of that together, term premium needs to go higher. Now, that is not so much of a contrarian view. I think many people share the view that term premium needs to reprice, but it's just a matter of when, right? So our conviction around curve steepening is stronger over a strategic horizon rather than a tactical horizon, where we're really driven by a confluence of factors coming from macro, coming from central banks, coming from earnings, and coming from election headlines.
What about credit then, in an environment where rates are higher for longer? We've seen relatively narrow spreads. Are there pockets within credit that cause you concern? Is the BlackRock red light flashing on any of these particular credit names where there's concern in a higher for longer environment?
Yeah, so for credit, we have a quality preference. Yes, spread is very, very tight, both for investment grade and for high yield, but total yield is attractive, right? So let's not forget about that in terms of, income is really back in fixed income after years of not being back. But we're seeing signs of, for example, the CCC within high yield coming under a little bit more pressure in response to high for longer being around for a while. So we definitely want to be selective within the credit bucket and focus on quality at this juncture. I would also say, though, if we have the risk budget, then we have a global multi-asset kind of universe to play with. Equities is still where we would like to deploy risk, because that's where we can tap into the earnings momentum and the growth momentum.
The fact that there's still someone out there who says they actually want to hop into equities right now, given the rally that you've seen, I think is fascinating. Wei Li, Global Chief Investment Strategist at BlackRock, joining us around the table. And of course, as we talk about the heavyweights of the United States, let's talk about the heavyweights right here in Europe and get a quick check on the Sensational Six, specifically how they're trading this morning. Novo Nordisk, I'm going to start left to right here, is one of your underperformers here, actually, alongside LVMH, both down about 0.5%, which I think is interesting. And we were just talking about the tech trade with Wei there. You actually are seeing the tech trade outperform in terms of sectors this morning. ASML higher by 0.6%. Schneider Electric, I'm going to rope into that picture as well, higher by 0.3%. Of course, this comes after the rally we saw on Monday as well. But of course, Novo and LVMH are your underperformers. I want to get a couple of I'm going to start this over. I'm going to get a check on some of the individual stocks on the move. Joe Easton has that story for us. Joe.
So we got some decent moves to start the week off. Firstly, in the beer space, take a look at Heineken, down at 7% at the moment. Two things going on here. They have announced this impairment related to a business that they bought in China, booking a big sum on that one, given a share price decline on the business that they bought around 6 years ago. But also weakness in their general organic growth. Organic growth actually negative in Europe in the last period. And as such, we're seeing declines in some of the peers as well, including Carlsberg, also AB InBev, the maker of Stella and Budweiser, and also Guinness maker Diageo slipping as well. All of the beer makers lower following the update from Heineken this morning. Then in terms of some other earnings-related moves, some decent numbers on the screen here as well for Philips. Philips up 8%. Two things going on there as well. The order intake in the US does seem to be rebounding in terms of their health tech, and also the sleep apnea devices issue is fading away, as the CEO was discussing earlier on the show. Then we've got Merck. They reported after the close of trading on Friday. This is, of course, the German healthcare and also chemicals company. Pretty strong sales in some of their cancer businesses for them as well. And in London, we've got Pearson declining. This is a stock that's exposed to AI risk in terms of their education business. They are seeing a decline in some of their sales, according to the company state. That one declining 4%. But the biggest move in the UK and in Europe as well today is Reckitt Benckiser has slammed once again, following news of a jury awarding almost $500 million to the family of a child that was sick after using one of their baby formulas. Now, this could also weigh on Abbott Labs over in the US, so keep an eye on that one in US trading later. But we can see Reckitt down 9%, really worrying. There's a number of other cases similar to this outstanding. They go to trial in September, just over a month away. Keep an eye on Reckitt as we head through the morning. In terms of your morning calls, all the defence stocks are higher today. The sentiment for the sector has been impacted by the escalation of tensions in the Middle East over the weekend, but also we've got an upgrade for BAE Systems over at Citi. They go to buy, liking the valuation on that one. And then finally, going the other way, we've got a downgrade this morning coming through on Stellantis. You remember that stock fell 10% last week following earnings, and Deutsche Bank is catching up with this one today, downgrading it to hold. It's still up 0.2% because of that drop last week, but Stellantis gets a downgrade on weak margins. Those are your biggest movers this morning.
Nice one, Joe. Joe Easton from our equity team, thank you very much indeed. And more on one of those names that Joe was flagging for us. Heineken shares falling, of course, after a show said, after taking an impairment charge of almost $1 billion for its stake in China's largest brewer. We're going to break down the earnings from the Dutch beer giant next. The stock down 7.3%. This is Bloomberg.
We had a very solid and positive first half of the year. Also, we are quite pleased with our China partnership. The impairment that we had to take, a non-cash impairment, is a technical adjustment that we have to do because as a minority participation, we need to value this on the share price, and the share price of CRB listed in Hong Kong dropped below the level that we acquired the company.
OK, the CEO of Heineken speaking to us earlier in the show and suggesting that they remain positive about that partnership with that key Chinese brewery, despite that impairment charge of almost $1 billion. Investors, though, taking a turn on this stock and looking at things much more negatively than the CEO had been suggesting. Currently, the stock down 7%. We'll see if that adjusts through the session, of course. Again, the CEO suggesting that they're seeing relative resilience in terms of the demand and the volumes in Europe and in Asia, despite that hit and despite that impairment charge. Longer term, he thinks that partnership is going to pay off. But he was also pretty conservative on the question of pricing, suggesting that he is a little cautious about the consumer and to what extent they can absorb those higher prices, something, of course, they've had to push through as a result of those high input costs and wages. Again, currently the stock on Heineken down 6.8%. We've also had some lines crossing, Kriti, from GSK, which we think are pretty substantial given the overhang when it comes to Zantac and the relationship there in terms of the potential headwinds and the regulatory squeeze on that company.
Yeah, and I think this is interesting. When you look at some of the analyst commentary, and I imagine we'll get a little bit of this in the next couple of hours as some of the kind of investor community kind of wraps their head around what this actually means. But this was a case that was really seen as keeping the stock range-bound for a very long time. You said that was the wording used out of Guggenheim. You had a downward come out of UBS as well, just basically saying that this is the overhang. This is kind of the breakthrough moment. And yet, to your point, you're actually seeing, I mean, the stock is flat right now, given that now it feels like that overhang is removed. But I imagine the details of what that agreement looks like and how much they may actually have to give up as a part of that settlement will feed into that narrative.
Yeah, I said regulatory scrutiny. It's legal scrutiny because this is a court case in the US. And again, the line coming through, GSK reaching an agreement relating to Zantac litigation. Let's get more on Heineken, though, right now, and the details, the numbers that are crossed, of course. And bring in Dasha Afanasneva, my apologies, Dasha, in terms of what the numbers mean for this business. What stood out to you then, Dasha?
Morning. What stood out to me is that there's actually a miss on a lot of the revenue, pretty much all of the regions. There was a miss there compared to what analysts expected. The company gave an outlook for the year, which is between 4% and 8%, which isn't that different to what we expected. But I think it shows that it is a challenging environment across many regions for Heineken in this area where, you know, time when they were increasing prices loads like a lot of consumer goods companies, and now the consumers had enough. And the volume isn't growing quite enough to make up for the price rises that aren't there anymore.
Yeah, well, we were literally talking about that. How much more room do you even have for if a consumer were even willing to digest that? How much room does Heineken even have to see that? This impairment charge, though, is fairly interesting because I'm curious how much of this is, as they say, a one-time charge, and how much of this is more reflective of the weakness out of China.
Well, you only have to do the impairment once there's sort of a long-term devaluation in the value of the asset. So I don't think it's quite right to say that it's sort of, you know, a complete one-off and a technical thing or anything like that. I know that the CEO told you that they don't think that the market value reflects the value of that business. And we do know that there's problems in the Chinese economy, particularly at that premium end. There's a real estate. They're trying to deflate the real estate bubble. The consumer is under pressure and they're not willing to spend as much. And the other point is that back in 2018, when that deal was inked, it was quite an expensive deal. The company was valued in line with spirits companies almost, which do get a higher valuation. So now they've written down a third of that, and the premium, this whole promise that China had for them, doesn't seem to have materialized.
Yeah, that's been questioned, isn't it, Kriti?
Yeah, no, I was going to say that it's a fascinating point. I didn't actually realize that the spirits business would then have that, well, literally a premiumization built into the business in addition to that as well. Bloomberg's consumer goods reporter, we have to leave it there, Dasha Afanaseva, giving us that crucial context on the Heineken stock hit that you were seeing. Again, those shares down almost 7% in trading. Coming up, it was Train's Reign and Celine Dion during the first weekend of the Paris Olympics. I'm excited about this. We're going to dive more into the details next, especially as we talk about some of that premiumization and the read-through that you're getting into some of the sponsors' numbers. More on that next. This is Bloomberg.
They're spending over $1 billion when they're here in Paris. So we're seeing really good demand this summer. I think Q3 is going to be quite strong. And I think this event, the Olympics, is just the ultimate demonstration of the power of Airbnb.
The Airbnb CEO there, Brian Chesky, speaking to our very own Bloomberg Caroline Conan on the Paris Olympics and how it's affecting that demand story. I want to stick with that because, of course, we ended Friday with quite a bit of drama, I want to say, when it comes to the security situation in France, where French rail services were, of course, impacted. They are now expected to be back to normal after the network was sabotaged by, as yet, unknown perpetrators ahead of that opening ceremony. I want to get more on that story. Bloomberg's Caroline Conan joins us this morning. Caroline, walk us through the disruptions. Do we have the all clear in Paris now?
The situation is actually back to normal today. Olympic travelers and French holidaymakers can take their trains to the north, the east, the west of France if they want to. SNCF agents worked under the rain over the weekend in order to make sure the traffic could go back to normal as soon as possible. Even though 800,000 passengers were potentially affected over the past couple of days. In fact, the Interior Minister, Gérald Darmanin, was speaking just this morning on French television saying that the investigation is still underway, but it seems like it is the signature of the radical left, and about 50 people from Extinction Rebellion, some radical environmentalists, actually have been arrested over the weekend. And the only other hiccup we saw over the weekend was about the quality of the water of the Seine River. The triathlon training on Sunday was cancelled because there was heavy rain, as you saw during the opening ceremony, and also on Saturday. That's impacting the quality of the water, but organizers are confident the quality will be restored for the competitions which start tomorrow. And as you know, French authorities have spent 1.4 billion euros in order to make the Seine swimmable. Even the Paris mayor, Anne Hidalgo, took a dip a couple of weeks before the game.
Caroline, I made was it a mistake, possibly a mistake, of looking at the front page of Fox News a couple of hours ago, and it was screaming about the woke, quote unquote, the woke opening ceremony in France. A lot of hand-wringing there. Have things calmed down, the controversy around this opening ceremony?
Yeah, I don't know if you watched it, but generally the opening ceremony was seen as a bold success, a celebration of diversity by most French press, most foreign press. Of course, there's always a little bit of controversy, and there was one scene in particular that shocked especially the conservatives and the Catholics, which was the scene with dancers and drag queens at a banquet, which was seen as a parody of The Last Supper by Da Vinci. And the Catholic Church complained, the conservative politicians complained, even Elon Musk posted on X that this was very disrespectful to Christians. So over the weekend, yesterday, there was a spokesperson for the Paris 2024 Olympics Committee who actually apologized, saying that if there was any offense there, it was not intended. So other than that, the ceremony, as I mentioned, was seen as a bold success by about 96% of the French. That's according to polling by the IOC. And there was no other major security hiccup over the weekend. 65,000 police officers, military are mobilized during those games. And I got to say, I was at fencing on Saturday. I was at tennis on Sunday. The atmosphere here is electric. The mood is great. Perhaps a little pause before the political drama that will unfold later. We expect a new prime minister after the games.
Man, Caroline, you are really hyping it up, and I'm thrilled about that. But I've got to kind of throw perhaps a little bit of cold water on it because you made a crucial point about the politics as well, and a lot of the economics, specifically because we've heard, and you've covered this so closely with some of the sponsors as well, that so many companies are saying, well, actually, people are leaving Paris, and that's going to hit their bottom line. And I'm curious if the weekend has changed any of that commentary.
It is true when you walk around Paris, a lot of the restaurants, a lot of the streets are not as full as usual, not as full as you would expect for a time like the Olympics. And we saw some numbers with, for example, the hotel rates down about 40% from their peak rate about 11 months before the Olympics. But you heard from the Airbnb CEO that I interviewed on Friday saying that there is a lot of occupancy, about 70 to 80% in terms of Airbnb flats within Paris. Yes, it's a lot of Olympics travelers because those tourists, those wealthy tourists who usually come during summer, perhaps decided to delay their trip to Paris. So we'll see how this unfolds and the numbers we'll have after the games. But so far, yes, it's mostly Olympic people. A lot of Parisians have gone away.
OK, Bloomberg's Golan Gunnar in Paris on the Olympics. And a line crossing just in the last minute or so, in fact, on the question of sabotage. This one focused on fibre networks. This is a new line reported by AFP, the French, of course, state news agency. The French regional fibre networks have been sabotaged, Paris unharmed. That is the line coming from AFP. Again, French regional fibre networks sabotaged, but not impacting Paris, according to the AFP. We'll keep across that story for you, of course, and the details as and when we get them. Now, switching focus, the Italian Prime Minister Giorgia Meloni is pledging to relaunch bilateral cooperation with China. She is on her first visit to Beijing since snubbing the nation's flagship Belt and Road Initiative last year. Let's bring in our Asia government and economy correspondent, Rebecca June-Wilkins, in Hong Kong. Rebecca, how significant is this, then, when it comes to ties between Rome and Beijing?
Well, it's really significant on both sides, I would say. For Italy, as you say, it's the first trip for Giorgia Meloni back to China since she left the BRI, caused quite a few, ruffled a lot of sort of diplomatic feathers when that happened. She was the only G7, the only NATO country to be a member of China's flagship foreign policy Belt and Road Initiative. And at the same time, she is here now in Beijing to reinvigorate, to relaunch that diplomatic relationship. China and Italy have had a strategic partnership for more than 20 years. They've essentially signed an agreement on everything ranging from education, investment, the environment, food security, to renew that for another 3 years. But for Meloni, it was something of a high-wire act. But for Beijing, too, this is significant. Against this backdrop of tariffs and worsening relations between China and the EU, and indeed between China and the US, that mounting pressure that China faces, it really needs all the friendly faces it can get, particularly advocating on its behalf in the EU itself.
Well, talk to us about that dynamic, though, because, yes, you do see Giorgia Meloni specifically trying to make perhaps some of those inroads. But you talked about itself. This is a touchy environment between both sides, especially when it comes to the possibility of tariffs. We know those EV tariffs still loom over everything, not to mention potential sanctions from the United States on ASML and the Dutch government as well. Walk us through just kind of maybe some of the other kind of key touch points when it comes to that conversation.
Yeah, I think that's right. All of those sensitivities sort of overhanging in the room there. As far as we know, EVs haven't directly themselves come up, but Beijing certainly is looking for a figure like Meloni who will go back to the EU and advocate on their behalf not to continue rolling out what they see as sort of punitive, constraining tariffs on those goods, particularly those clean energy, green tech goods. These are the sort of foundation of China's rebound. As we know, we've seen that rebound has been very unbalanced, very much dependent on exports, and that's partly why it's so critical that they are able to sort of positively influence the EU in this direction. The other thing, of course, for Beijing is that they're facing a potentially tougher period if Donald Trump returns to the White House. We could see a further deterioration of US-China relations, which again puts that relationship with the EU back in focus. My colleague Donato, who's traveling with Meloni to Beijing, has done really interesting reporting saying that part of Meloni's thinking when it comes to President Xi Jinping is that she views him as someone that could be increasingly important in, for example, the resolution and the course of Russia's war in Ukraine, as well as over other conflicts, particularly if Trump comes in power and does end up pulling back some of that support from Ukraine. So she sort of sees President Xi, and indeed thinks partly of herself, as the potential sort of mediator or negotiator in these global conflicts too. So this is very much a sort of calculation about the long-term relationships that, as she puts it, nations like Italy, but also that partnership with President Xi Jinping, that positive relationship with President Xi Jinping could play down the line.
Yeah, Rebecca, the geopolitics is really fascinating in terms of the conflict in Ukraine, of course. How does Beijing view Italy now under Meloni, do you think, given that Italy was, the only G7 member, certainly the only European country to sign up to the Belt and Road Initiative when it was launched, and then, of course, under Meloni pulling out of that, partly under pressure from the US. How does China forgive her for that, given they need that proximity to Europe in the face of a potential Trump presidency? Or has that burnt relations longer term for Italy?
Well, I think so far the charm offensive does seem to be working by Meloni. She is set to meet President Xi Jinping today, and really from those readouts, I think, is where we'll really be able to sort of get a proper sort of read on the room of how Beijing feels. But I think at this moment it does appear that she is sort of successfully ingratiating herself back in the fold with Beijing. She has spoken somewhat about the need for fairer trade with China, but we haven't seen a lot of discussion, for example, about overcapacity and so on. So sort of somewhat steering away from some of those more sensitive topics. I took a quick scan at state media, didn't see much mention of those either. So far firmly sticking to these sort of more topics where they can be more generous cooperation. There was a pretty expansive sort of agreement for the next 3 years between Italy and Chinese ties. But I do think a big part of this, from Beijing's point of view, is this sort of practical viewpoint that it needs the sort of partners, the friends and allies that it can get at this point in time. And for Meloni, of course, something of a high wire act, but she does seem to have been able to sort of navigate this quite delicately and with a degree of finesse, given that, of course, she's also speaking to a domestic audience at home where she's promised that, China wasn't delivering its part of the bargain on BRI and, needed to be a little bit tougher when it came to trade. At the same time, also, of course, for their own economic reasons, trying to firm up that financial and economic bilateral relationship between Italy and China.
OK, Rebecca Jean-Wilkins, thank you very much indeed. A fantastic wrap of that important visit with, of course, the Italian leader on the ground in China and what may come from that as well. At a time, of course, when the EU-China relationship has just seen a significant readjustment. It was just 3 years ago or so that the EU had hammered out an EU Investment Act with China, which was then scrapped. So the mood in Brussels in terms of the change in sentiment towards China in the last 3 years has just been significant in terms of the solidifying, the crystallization of a more negative tone. But the question, which Rebecca was alluding to, as to whether or not if you get a Trump presidency, does that actually start to moderate? Does Europe start to moderate its position back to where it was 3 years ago if you get a Trump in the White House come January 2025? Well,
that's a crucial economic point. And I'll add the kind of geopolitical and almost diplomacy point as well, because initially this negative tone follows, to your point, that Europe was supposed to be kind of the neutral party between China and the United States. And now it feels like China is actually trying to be the neutral party when it comes to the conflict between Ukraine and Russia. It's also even negotiating in terms of Israel and Gaza. And I thought that was really interesting, that China's trying to play that role at a time when so many people are trying to play that role. I'm going to throw Viktor Orban into the mix. I'm going to throw Qatar, for example, into that mix as well, about who actually is the diplomat and does that open the door then to making some more of that economic policy?
Of course, Finland's Prime Minister talking to Bloomberg a couple of weeks ago and saying all it would take is Beijing to pick up the phone to Russia to end that war in Ukraine. Really interesting. We continue, of course, to monitor that visit by Meloni in China. Coming up, talking of Donald Trump, the former US president, calling for the US to become the world's crypto capital. Our big take on his journey from skeptic to Bitcoin cheerleader is next. This is Bloomberg.
Welcome back to the opening trade. We're at 47 minutes into today's session. You are seeing some green on screen when you look at European stocks here. And it's interesting because the outperformer is right here in the UK. And what is driving the outperformance? Well, a lot of it is actually coming from your big oil names, despite we're not seeing that many big moves in the underlying asset as well. To the downside, though, the underperformer actually seems to be the French index. The CAC 40 there down about 0.2%. It's the only index right now in all of Europe that is in the red. And a lot of that simply has to do with the LVMH weighting. It feels like LVMH is taking a little bit of a hit today. And then again, dragging down not only the French index, but the entire stock 600. So that's your macro picture. But I want to go through some of the movers that we're keeping our eye on, because Heineken is, of course, top of the docket. They did come out with an almost $1 billion impairment charge when it comes to their stake in a Chinese brewer. This is really important because we, of course, spoke to the CEO, and they said, look, this is a one-time charge. This is a technical impairment. This is not indicative of what you're seeing broadly. And yet you still look at the volumes. You look at the concerns around the Chinese consumer, and that's where you perhaps perhaps see a little bit of the hiccup. Those shares down by 6%, Tom.
On Philips, it's a bit of a turnaround story for a company that struggled with having to face these recalls around its key sleep apnea devices. Today, as you can see, double-digit gains, more than 10%, on a story that suggests that the sales are coming back for this Dutch company. That rise, by the way, is the most in 3 months in terms of the stock rise. So they reported, and they have reported second quarter results with the order intake gaining for the first time, in 2 years. Jefferies analysts saying that visibility has improved for Philips, and of course the stock being rewarded on the back of that. Reckitt, very different story, and a tragic story, in fact, when it comes to the individual news behind this. This is related to a charge of around $500 million in terms of damages that a US court has ordered Abbott Laboratories around a case that involved baby formula causing an infant's bowel disease. Horrendous. But Reckitt Benckiser, in terms of the corporate story, faces a similar trial of its own, and so is taking a knock on the back of that story, currently down a little over 8%, as you can see.
Yeah, it is certainly a tragic one. Of course, you are seeing, I'm going to kind of macro this out, but some pretty big moves, some of them off the earnings story, some big off of the development list. We're going to keep you apprised of all of that. But let's talk about something we don't often talk about on the show, which is Bitcoin, especially in the context of U.S. politics, touching a 6-week high after a speech from former U.S. President Donald Trump and, of course, current candidate and Republican nominee, who has pivoted from crypto skeptic to one of its biggest advocates.
This afternoon, I'm laying out my plan to ensure that the United States will be the crypto capital of the planet and the Bitcoin superpower of the world, and we'll get it done.
Now, that speech has capped a complete about-face of the former president's stance towards an asset class he's considered in the past a, quote, crime-riddled scam while he was in office. Now, the former president was speaking at the Bitcoin 2024 conference in Nashville over the weekend. It's a really interesting dynamic to fold in U.S. politics and crypto. Who better to do it than Emily Nicole, who joins us now. Emily, walk us through this journey, which I think is an interesting a way to put it. How did we get here? Why did he kind of change his mind?
So while Trump was in office, he was an outspoken critic of crypto. He thought it had no value. He thought it was a criminal enterprise. And it has all changed now, nearly 10 years later since he first entered. Bitcoin now is a key part of what the Trump campaign sees as its appeal to innovation, its appeal to technology. It's got a lot of entrepreneurs on its side. A lot of crypto CEOs have come out in favor of Trump. And what he's promising them is the thing that they most want, which is to fire the SEC chair, Gary Gensler. Crypto CEOs think that Gensler has been a staunch advocate for putting traditional regulation onto crypto, something they think doesn't fit. And so key to that tie to Trump is to get rid of Gensler on day one, something he probably doesn't actually have powers to do. But nevertheless, he has promised it.
What is the potential political upside for the Trump campaign from this? I mean, how widespread is there? A big enough kind of Bitcoin and crypto industry to actually make a difference in the margins when it comes to the numbers, political numbers for the Trump campaign? What's in it for them on this?
Yeah, it's a great point, because crypto itself is a $2-point-something trillion industry. Not that huge if you think about it in comparison to things like commodities or oil or stocks, but it does have a lot of political sway. The super PACs that have been raised by crypto companies have got millions and millions of dollars under their belt. They're distributing them to bipartisan campaigns, but Trump is by far the campaign that outwardly crypto industry thinkers prefer the most. And so there's a lot of dollars floating around that he can earn as a fundraising point. Trump on stage in Nashville on Saturday was talking about how many millions of dollars he's raised since accepting Bitcoin directly to his campaign. And so there's a lot of potential for him to win money there. There are also some voters as well. If you listen to Coinbase, which is a big crypto exchange, they've been doing some research and they have a massive campaign around just the power of the voter base that crypto can command. But, it's the dollars that really matter here.
Has there been reaction from the crypto industry itself?
So on Saturday, there was obviously a lot of demand and kind of pent-up excitement for Trump going on stage. The Bitcoin was making a lot of kind of volatility moves in the gear up to that. And since then, as you said earlier at the start of this, Bitcoin's now at a 6-week high. It's definitely done well since Trump was on stage. So the industry in general, in terms of pricing, that they're receiving this positively. However, there were also some other dissenters who on social media platforms like X were saying, I'm not all that convinced by what Trump had to say. So it definitely it could have gone either way. But in terms of the actual asset class and whether or not it's bouncing, it is. So mostly, I guess you could say they've accepted it as a positive.
All right, Bloomberg crypto and fintech reporter Emily Nicole, we have to leave it there, but we thank you so much. Of course, check out the big take. It has a really interesting dynamic when it comes to the marriage or lack thereof between Trump and the crypto space. But Tom, I think this was a really fascinating story, and I try to shy away from crypto because it can be a little bit wonky in terms of its kind of market plumbing and what drives the price. Some of it's Fed indicated, some of it is flows from other parts of the world, and it can get, again, there's mining involved. It gets very nerdy very quickly. But I think what's interesting is that the fundamental kind of reasoning of when crypto kind of blew up in terms of getting more of a standing and more of a crowd and more investment is that it was this deregulated, decentralized, kind of almost populist kind of movement. You saw it in the meme crowd as well, or meme stock crowd as well, which, by the way, I should point, the connection there for Donald Trump is that is the very principles he's appealing to in the Republican Party from a political standpoint. He also, by the way, has his own stock, his own media company, if you will, DJT, which is the ticker for it. That was also a spinoff of a SPAC, and also serves in a lot of ways as a meme stock in among that retail crowd. So I think the marriage of the two is really fascinating. Not to mention that Elon Musk, of course, has plenty to say on both topics.
Yeah, and of course he's now a key funder of this Republican campaign, isn't he? One key piece of colour, you can see the images on the screen, because this was in the Bloomberg Big Take as well. And Emily skirted this one, but one of the key lines was that one of the things that attracted Trump to this was he had his own NFTs made up, and he priced them at, what, $99 per NFT, and he was talking in the speeches, maybe I should have priced them at $1,000. But he was obviously enamoured by the idea of his own image. It's not the first time we've seen that with Trump. And there you go, you can see some of the NFTs that depict Trump there that have been sold. So that's part of the story. So we'll look at the money flows. That's going to be really interesting. The Winklevi, the Winklevoss twins, the Winklevi, they've donated money. Elon Musk, of course, donating as well. Crypto up, 50% year to date. And you're absolutely right. Linkages to rates. Now it's linkages to the politics in the US and the prospects of a Trump presidency. Now, let's get through what else is on the agenda this week. A massive week for these markets. In terms of foreign policy, foreign ministers from Japan, US, Australia and India meeting to discuss the South China Sea disputes. That's really crucial in terms of geopolitics. Then the UK Conservative leadership nominations close. A couple of names already, at least 4 or 5 names have thrown their hats into the ring over the weekend, that being firmed up. Tuesday, Euro area economic confidence, GDP and consumer confidence. Microsoft, a big one, of course, in terms of the earnings story, reporting on Wednesday. The BOJ and Fed rate decisions, of course, we've been talking about those, really significant. Will the BOJ go with a rate hike and a roll down in terms of its bond purchases? Meta earnings come through on Thursday. The Bank of England, that rate decision, it is finally balanced, 50-50 on Thursday. Amazon and Apple reporting, of course, on Friday. US payrolls, I'm sure Kriti has a view on this, and then Exxon and Chevron in terms of the earnings. And Kriti tied in the oil price moves earlier. But US payrolls, non-farm payrolls coming through on Friday. I don't know if you're convinced that this is a softer labour market that we're seeing in the US.
Well, I don't even know what the most tradable event is of the week. Is it the central bank decisions? Is it the earnings stories? Or is it that payrolls report? I feel like so often on Monday we have this conversation. There's so much going on. And on Friday we end up exactly with the uncertainty and skepticism that we started up with Monday morning. At least that's the macro story. There's plenty going on. You've got me for the pulse up next. We're going to talk about these markets. We're going to talk about these major movers. And, of course, the geopolitics over all of it. Stick with us. That conversation next. This is Bloomberg.